Okay, this chapter is talking about merchandise. And so we'll be talking about the purchase of merchandise and the sale of merchandise. So this critical information. And so it's a lot of things that I need you to understand. Some foundational things here at the beginning that would help you to understand more about merchandise, even though it might not be stated exactly like this in the textbook. It's just some things I think you need to know. First, a merchandising business has sales revenue. That's what we've been talking about a lot. But that's what we'll be talking about a lot in this chapter. But in earlier chapters, a lot of times we talked about service revenue. And so they don't usually use the word sales when they're talking about service revenue. They usually use fees earned or service fees, professional fees, revenue, that sort of thing. But the terms, some terms that are interchangeable, the word merchandise is interchangeable with inventory and then also interchangeable with the word goods. So we have goods available for sale is the same thing as merchandise available for sale. And basically there's two ways to arrive at goods available for sale. And that is you could take the beginning inventory and add inventory that you've purchased this month, and that would give you goods that are available that you can sell. Or you could look at how much goods were sold and how much ending inventory you have. And the combination of those two would tell you how much goods had been available that month. So you can come at it from the top or the bottom, and you'd still be at the correct answer of goods that were available. That's an important thing to understand about it. It helps you in this class. It helps you in some functions of the financial accounting classes, and then also very much helps you in the cost accounting class. And in the managerial, intro managerial class, of course, too. But basically, goods available for sale is this magic number that you need to find out a lot of other answers. And if you have a missing piece in any of those inventory factors, you can find that piece by knowing and understanding about goods available for sale. And that's just because you start with some inventory and then you buy some more, and that brings you to the amount that's available. That's all you have. It's your limit. And then of that part that's available that you have that you can sell, you either did sell it and therefore it becomes cost of goods sold, or you still have it on hand, and that means it's your ending inventory. So that's why the number can be arrived at by two angles. You can take your beginning inventory and your inventory purchased, and that will tell you the goods available. Or you could look at it from the other perspective of how much do I still have at the end of the period and how much did I sell? And that will tell you how much had been available all the time. So I know I repeat the same thing because I'm trying to make it stick. Okay, so now let's go to another thing. If we had a sale of an item that cost us $40, that we sell for $40 and it cost us $10, we would have what's called a gross profit of $30. Sales minus cost of goods sold is $10. So some of these, I sometimes just say GAFS for goods available sales. Sometimes I say COGS for cost of goods sold. So I think you'll get used to those pretty soon, but a lot of times I'll just have the initials there and I'm saying the actual phrase, but that's just because it's a lot easier to write COGS than it is to write cost of goods sold. But anyway, if you have sales of any number and you know the cost of goods sold, you can tell me what the gross profit is. Okay, so cost of goods sold is, let's just assume that in this case where we had cost of goods sold of 10, that it was made up of this. Inventory at the beginning had been 5. This is the cost of the inventory. Plus we purchased $12 more of inventory. That gave us goods available that we could sell of $17 or $17,000. 17 million. It can be anything. We're just using small numbers so we can relate to it. But if goods available had been 17, then if we knew we had ending inventory of 7, that would tell us, well, we must have sold 10 then. Or if we had goods available of 17 and we knew that our cost of goods sold was 10, we would know that 7 of it must be still available in the ending inventory then. At the same time, if we knew goods available was 17 and we knew we started out the year or the month with 5 in the inventory, then we would know we had purchased 12 more. So that's a lot of that is missing pieces that we're going to see over and over in these scenarios of trying to understand and learn about accounting, especially related to merchandise. So expenses so far almost always said the word expense, but this is where we add some costs that are not saying the word expense, but they are an expense. Cost of goods sold is the expense related to the sale. And so says the word cost instead of expense, but it's still an ordinary expense account. So when you go to do things like closing, it still will be part of the closing entries for expenses. Okay. A sales transaction has two entries that you record at one time. You record the sale, just like we always would have with service revenue, where we debit cash or accounts receivable, one or the other, and we credit the revenue. So in this scenario I talked about where we made a sale for $40, we debit cash or accounts receivable for $40 and we credit sales revenue. And then at the same time, we record the cost. This is called the perpetual inventory methodology. And so that's basically what everyone uses now. And so we record the cost at the same time we record the revenue. So the cost is recorded with a debit to cost of goods sold and a credit to the inventory account, also known as the merchandise inventory account. Any of those words, merchandise, goods, inventory, it all means inventory. Okay, so whenever you go to Walmart and you buy anything, I'm trying to find something here that I bought at Walmart. Let me see. Here is a Spring Valley vitamin bottle, and this was bought at Walmart. And so whenever it was bought, this little scan code is what we use to decide how much that Walmart's going to charge me. So it's like, you have to work for yourself when you buy something from Walmart. So here I am at the register scanning it myself to let them know how much to charge me. So whenever I do this scan, it automatically picks up the price. I have no idea what I paid for this, but if it picks up the price, but not only that, in Walmart's accounting records, it picks up the cost of this bottle of vitamins. So it makes this double entry that I'm just mentioning every time they scan something. So if I have like 100 items in my grocery basket, which I normally do, then every time it's making this double entry in their system. I mean, it's not making a complicated thing. It's just tracking it according to this methodology that we're showing you. We're showing you a manual way of doing it, but the computer is doing the very same thing in the background. It's recording a sale with a debit to cash, and it's because they don't sell things to me based on credit. So they would never have that. Walmart doesn't have on their records accounts receivable Janice Weber. No, they want cash every time they sell something to Janice Weber. So they debit cash in their accounting records. They credit sales revenue for this vitamin bottle, and then at the same time they debit cost of goods sold and they credit inventory of Spring Valley adult multivitamin gummies. Right? Okay. It's not an endorsement. It just happens to be what was sitting there. Okay. But in any case, that double entry is part of perpetual inventory accounting. Okay. So it's sort of like when a company has a supplies inventory and they have like this closet at the end of the year or the end of the month. And so they have all the supplies there. And when they use them, they move some of the cost over to the supplies expense account rather than just leaving it all sitting on the balance sheet as supplies forever. So if you're using a periodic system, then that would be the system where you buy a bunch of supplies all during the year and you always debit it to supplies, the asset. And then at the end of the year, you tally up, go in the closet and count up how much is still there, and you adjust that inventory down to what the actual number is. That is adjusting it on a periodic basis. But this thing where Walmart and most companies scan in the item and record the cost at the exact same time, that's called perpetual inventory. Okay, so mostly we'll be studying about perpetual. And that's what it is. Perpetual includes computers, barcodes, and scanners, whereas periodic is an end of the period count with an adjustment through an adjusting entry. A return of inventory is just like it sounds. If you buy something and then you record it as a sale along with its cost, then you come back and you say, hey, I didn't need this. I'm sorry, I bought the wrong thing. And so if you take it back, or if your customer brings it back to you, the return is just what it sounds like. It's a return or a reversal of the entry. So when you make it, if you're selling goods and someone returns product to you, you reverse the sale part of the entry and you reverse the cost of goods sold part. So here's an example. This is an original sales entry. You debit cash, you credit sales, you debit cost of goods sold, you credit the inventory account. So that's recording the transaction with their double entry. Then when they return something, we debit sales, but if we want to keep track of the returns, we debit an account called sales returns and allowances. Some companies go directly to the sales account and just reduce it, just reverse it. Other companies, and most of them, track sales returns and allowances in a separate account so they can see how much is coming back from customers as returns and allowances. It might be a quality indicator. That's one reason why they do that. And then, so we're reversing the entry. You saw in the original entry, we debited cash and we credited sales. Now we're accepting this return from the customer. So we're debiting sales and crediting cash, or debiting sales returns and allowances. And then the cost side of the entry, when we recorded the sale, we debited cost of goods sold, we credited inventory because we were indicating that we moved something out of inventory into the expense account, cost of goods sold. Now, when they return it back to us, we have to reverse that. So we're debiting merchandise inventory and crediting cost of goods sold. And that's just for the part that was returned. We'll have some examples where we practice that in a minute. Okay, an allowance, on the other hand, it's not like a return exactly, because this is when the client calls you up, they're like ranting and raving and saying, what is the deal with this? This product is substandard. I don't appreciate it. And they're like, whoa, hang in there now. I don't know what happened, but something is off. That is not the way we do business, and we want to make an adjustment for you. So we're going to make an allowance about this product. So what we do to our customers, give them a credit on their account that just reduces their price on that goods. Rather than saying, ship it back to me and I'll give you all your money back, we say, you keep it and we'll just lower your price a little to adjust for this subpar quality. And so that is called an allowance. So some percentage of the sales price, we refund them. So we debit the sales account, we credit the cash or the receivable. If we're going to give them cash back, we write them a check for it. If not, we just credit the receivable account if they hadn't paid yet. The cost is left as it is because we didn't actually take the goods back. Okay. A trade discount is something that is given across the board, a bulk discount usually for a large quantity of purchase. A trade discount is just a reduction in the price before the transaction's ever done. This would be like Coca-Cola or any other soda company. If they were selling to Walmart or Target or some big corporation, they would give them a better price than they would, than they would like a little single convenience store that's just owned by mom and pop that doesn't order very much. So the quantity discount that's given is called a trade discount. It's a reduction in the price. You might see a list price, but then that's not the actual selling price because they had a trade discount. So a list price is not the selling price. It's just like suggested retail price, basically. And if you have a trade discount, so in this example I've given here on my note sheet, if it's a sale of $100 goods, list price goods with a 20% trade discount, that means you actually sold it for $80. So when you record that entry, that $100 is never going to show up at all. The sale is shown as a sale of $80 because a trade discount is just a reduction in the price. And usually it's about quantity discounts. All right, a sales discount, instead of a cash discount, is also known as a sales discount. And this is different from the trade discount because this one is talking about the credit terms. And it usually is for paying early that you get a discount. And this one, only when the method we're using, the periodic method, and reporting on the gross method, means you record the sale at the full price. And if they come back and take advantage of a cash discount or a sales discount, also known as sales discount, that we've offered, then we would show that discount at the time of the payment. So in other words, you record the wholesale. If they take advantage of the discount we offered, then we'd record that along with the sale. So we record the sale at the gross amount, and then the payment at the payment date, they might get a discount based on these terms. Here's how the terms would be stated. It might say, this is a very common one, 210 net 30. That means that's not like 2/10. That's not a percentage. Well, it is a percentage. Part of it's a percentage. That's just a way to state some terms. So basically, each of them means something. 210 means a 2% discount is being offered if you pay within 10 days. So 2/10 is just the 2% if pay within 10 days. Then the comma, then it says net. N means net. Net 30, meaning take 2% off if you pay within 10 days, or at least pay the net by 30 and by 30 days. And so there's also an unspoken nastygram along with these terms, which could just have another comma after the net 30 that says or else. Because or else, if you don't pay early and get your 2%, or if you don't pay within 30 days and pay the full net, then that means that you have some terrible things that might happen to you, which is the supplier might stop selling to you, or they might turn you over to collections, or they might start adding interest to your balance. So there's a lot of nasty things that can happen if you don't pay within the prescribed period. It's just unspoken in the terms. So the terms 210 net 30, 2% off if you pay early within 10 days of the sale, and then net is due within 30 days. Okay, purchase transactions, those were sales transactions we talked about. Purchase transactions are a lot, work the same, except for they're just from the other side of the equation. In other words, we purchase things and we resell them, but every time we sell something, our buyer is having to record it as a purchase as well. But in any case, we're going to look at it only from the perspective of our company and the fact that we're going to sell things and we're going to purchase things. So to purchase, you record the purchase under the gross method. That's a choice you can make, where you record the discount only if you take advantage of the discount, similar to what I was talking about with sales discounts. So you would debit merchandise inventory, and you would credit either cash or accounts payable, depending on whether you paid for it today or pay it in the future. Purchase returns reverse the purchase entry. So you would debit the accounts payable or cash and pay them back, and you would credit merchandise inventory. So it's just an absolute reversal of the entry to record. So that's a purchase return. Discounts would be computed after reducing the purchases for returns and allowances. So if you return some of the goods, you don't record, you look at the net amount to calculate your discount for payment early. Transportation costs is another area where you might have some adjustments regarding merchandise. And so there's terms that we need to understand about this one. FOB shipping point is talking about, FOB stands for free on board. I'm not sure why it's named that, but basically what it means is shipping is taken care of up until this point by the seller. And it's from the seller's perspective. So the seller says free on board. In other words, I'm not charging you anything for the transportation. I'll take care of it up until that point that is mentioned after the letters FOB. So if it says FOB shipping point, it means the seller is taking care of shipping up to the shipping point, and then the buyer's responsible after that. So the bill would be sent to the buyer for shipping if they purchase something on FOB shipping point. So if we sell FOB shipping point, it means that we are taking care of the shipping only up to the shipping point, and then the buyer has to handle it after that. So even if we pay it in advance, we will be billing the customer if it's FOB shipping point. Now, if it's FOB destination, it means the seller, again, the seller's perspective, the seller is going to take care to the shipping all the way to the shipping point. I'm sorry. If it's FOB destination, it means the seller is going to take care of the shipping all the way to the destination, meaning they will take care of all the shipping. They will pay for it, and they will not bill the customer because they agreed to pay the shipping when they said FOB destination. Now, sometimes you'll see if something's shipped from Dallas to Denver, that it'll say FOB Dallas if it means shipping point. If it's being shipped from Dallas to Denver, then that means it could say, instead of FOB shipping point, it could say FOB Dallas. And if it's being shipped from Dallas to Denver, again, it could say, instead of FOB destination, FOB Denver. So you could actually reference the city or instead of the word shipping point, the words shipping point or destination. But in any case, it's about who's paying the shipping cost. And it's always stated from the seller's perspective. Okay, so the seller's ownership and their responsibility and their payment requirements are all tied to this place where the FOB ends. Okay, so we're going to work some of these exercises and see what we can do. This first one, these are from Openstax. Let me see which one. This is from which chapter? Got it down here somewhere. From chapter 6 of the Openstax textbook. There's a link to it on the bottom of these notes. We'll start with EA6. We're going to record journal entries for these following transactions for the flour company. First, we purchased 85 bushels of flours with cash for $1,300. So that one is just a debit to merchandise inventory, a credit to cash. Then the second thing that happened, we purchased 240 bushels of flours for $20 per bushel on credit. The terms are 5/10 net 30. So 5/10 net 30 means you can have a 5% discount if you pay within 10 days, but at least pay the net by 30 days. And the invoice is dated October 30th. So when we record this, we're going to record it on the gross method, meaning we're not going to worry about that discount until the payment. So we're going to record the whole $4,800, 240 bushels times $20 as merchandise inventory debit and a credit to accounts payable. Then when we pay it on October 30th, we're within the 10 days, so we're going to get a 5% discount. So great, we multiply 5% times that 4,800, and that's how much our discount's going to be. It makes it a little smaller so we can see the facts at the same time. All right, so we're about to clear out our accounts payable with the debit, and we're going to credit cash. Well, first let's credit the merchandise inventory for the discount. $4,800 times 5% is $240. So we're only having to pay a check for the difference between the full amount or the gross amount of $4,800 and the discount. $4,800 minus $240 leaves us with a balance due of $4,560. They've got descriptions on this one, so I'll just reveal it. You don't have to put descriptions for journal entries for me on the test, but you can. And it makes it easier for someone just glancing at it, but you can just look at the transactions and see what happened too. All right, the next one's EA7. This one, we purchased 24 computers on credit for $560 with terms 4/10, net 60, invoice date November 6th. So again, this is a 4% discount if paid within 10 days, or just pay the net within 60 days at least. So they can change up the terms anytime they want to by just changing those numbers that are in the little, the term, little, just, what is it called? There's probably a phrase for this, the statement of the terms. That's the statement that says, here's what I'm offering. This is seller's perspective. Seller's always the one that sets the terms and the transportation terms too. So the seller says, I'll give you 4% off if you pay within 10 days, or at least pay the net by the 60 days. Okay. So on this one, I suggest that you pause the video and solve it and then come back to me and let me solve it and see if you're right. All right. So whether you did or you didn't, here's we go solving it. When you purchase those 24 computers, you're going to debit merchandise inventory and you're going to credit accounts payable. $13,440 is the total price because $560 times 24. And then you don't record the discount yet until such time as the payment's made, because this one reason you don't is for this next thing that's going to happen. On November 10th, they returned 5 defective computers for a full refund from the manufacturer. We did. We purchased them. We sent some of them back. 5 of them we sent back. And so that just reversed that part of the sale. We debit accounts payable for 5 times 560, and we credit merchandise inventory for that amount. So now we don't actually owe them that $2,800 at all. We owe them only $13,440 minus $2,800. So when it's time to pay, we pay them on November 22nd. Is that within the 10 days? Whoa, the 16th was the last day for the discount. So, we missed the discount. So there won't be a discount in this journal entry. There's just going to be paying the balance we owe them. So we debit accounts payable for the full balance we owe them. That's always the way of it. We're going to clear that accounts payable. We're going to credit cash for the full amount because we didn't get the discount. Okay. Then the next one, EA9. These journal entries are showing sales again. Sold 25 bushels of flowers to a customer for $1,000 cash. The cost of the sale was $7,000. So we're going to actually do the double entry where we show the cost, the sale, and the cost. Recording the sale means debit cash, credit sales. Recording the cost related to it means debit cost of goods sold, credit merchandise inventory. Then we sold again, that was for cash. We'll sell some more on credit, 40 bushels at $30 a bushel. And we'll record the cost related to that as well. They told us how much the cost was. It was $20 a bushel for cost. This one's on credit. So instead of cash, we debit accounts receivable. We credit sales for the total amount, which was this 40 bushels at $30 a piece. And then the cost was 40 bushels at $20 a piece, which was $800. So that's how we record the sale. Then on October 31st, we received payment in full, which was 10 days later. So the 4% discount is in effect. So they're going to give us the net. So we're going to get the cash of $1,152, which is the $1,200 they owed us, minus the discount of 4% that we offered them because they paid within the discount period. So we credit the full amount of the accounts receivable to clear it off the books. They don't owe us anymore. And we debit cash for the amount of cash they actually handed us after the discount.